Everybody, welcome back to Ox Talks. Thanks for tuning in to watch the show today. Thanks for supporting the channel, subscribing. If you're not subscribed, please hit that subscribe button. It's free to you, and we are trying to grow the community and keep spreading the word. So I appreciate you guys very, very much. I didn't get a video up yesterday. Got caught with a bunch of client matters and meetings here at the office, some late in the day phone conferences, but actually it worked out in hindsight okay because I want to share with you two sets of data, economic data. Both have to do with inflation, okay? One is yesterday's release of the CPI numbers, so that's going to be news that's 1 day old. You may have heard about it, you may have not heard about it. And then today, the wholesale prices came out, okay? Both of these reports I'm going to share with you. I'm going to address the CNBC articles. I'll weave in a little bit of something that the Zero Hedge also said about the CPI numbers yesterday. But I will tell you this, I'd love to get your thoughts and comments. I am very surprised that the stock markets are taking this news, let's say, as well as they have. Today, the Dow finished up over 300 points. The NASDAQ finished up well over 200 points. The 10-year yield, I didn't see the final close, but it's still hovering well over 4.5%, which is not a comfort zone for the markets. We've had Fed Chair Powell out 2 days ago, or for 2 days in a row, basically saying, look, we're in no rush to cut rates. So how is it the markets are staying so buoyant? We have Trump out today announcing reciprocal tariffs, which are now going to impact and apply to products coming out of Europe and the EU. So look, what's going on? The only thing I can put my finger on is that I see the dollar is weaker. The U.S. index over the past, I'd say, several days has fallen. It's down in the low 107 range, something like that. So we have a weaker dollar, right? And in a lot of respects, that's what the administration wants. They want a weaker dollar. And, usually that is stock market positive. But I'm, again, surprised as a lay person, not an economist, not an expert, surprised to see these market dynamics. And I think the real question is, will the markets wake up to the reality that inflation is not under control? Inflation, as we know, has never been transitory. Inflation continues to go up. Products that all of us need every day continues to go up. The consumers continue to struggle with basic necessities, medical care costs of food and shelter, and those things. So anyway, let me jump into the two articles, and then again, love to have your thoughts, your input. Your comments are always welcome as to what you see is going on. I've been saying this for weeks now. It's very, very strange. The dynamics are very strange. Yes, I believe from a business sentiment, businesses are starting to see that things are maybe heading in the right direction relative to, less restriction, less regulation, maybe less taxes. But I don't know. I just can't believe all this is baked into the cake right now. So first story was yesterday out of CNBC. Consumer prices rise 0.5% in January, higher than expected, as annual rate rises to 3%. As inflation perked up more than anticipated in January, providing further incentive for the Federal Reserve to hold the line on interest rates. And that is exactly what Fed Chair Powell said they're going to do. Now, will they actually hold and not further cut rates this year, or maybe only cut once or twice? We'll have to wait and see if this is just jawboning to appease the markets. Actually, it wouldn't appease the markets. Saying they're not going to be in a hurry to cut rates should have, for all intents and purposes, sent the markets into a tizzy. It didn't really yesterday, and today the markets rose nicely. The Consumer Price Index, a broad measure of costs in goods and services across the United States economy, accelerated a seasonally adjusted 0.5% for the month, putting the annual inflation rate at 3%. The Bureau of Labor Statistics reported Wednesday. And again, I will editorialize. We have to take all of that with a grain of salt. I think we all know that inflation is much higher than 3%. says they were higher than the respective Dow Jones estimates for 0.3% and 2.9%. The annual rate was 0.1 percentage point higher than December. Excluding volatile food and energy prices, CPI rose 0.4%, says on the month, putting the 12-month inflation rate at 3.3%. That compared to respective estimates for 0.3 and 3.1%. So yearly it rose 0.2% higher year on year. The annual core rate also was up 0.1 percentage points from December. Shelter costs, it says, continue to be a problem for inflation, rising 0.4% on the month and accounting for about 30% of the entire increase, according to the BLS. Food prices, no surprise here, jumped 0.4%, pushed by a 15.2% surge in egg prices. They say related to ongoing problems with the bird sickness that has forced farmers to destroy millions of chickens, it says. The Bureau said it was the largest increase in egg prices since June of 2015, 9 years ago almost, and was responsible for about 2/3 of the increase in food at home prices. Egg prices are up 53% over the past year. It says markets tumbled following the news, with futures tied to the Dow Jones Industrial Average sliding more than 400 points, while bond yields scaled sharply higher. I forget where the markets finished yesterday. They didn't finish up like they did today, but I want to say that the markets really tapered back the losses yesterday. Forgive me, I didn't mark it down. I believe closed about flat, or really it wasn't too much of a shock. The report comes a day after Fed Chair Powell indicated the central bank could be on hold for a while when it comes to interest rates. Okay, so that was the CNBC article. I briefly snapshotted a couple excerpts from yesterday's Zero Hedge article, and it says, finally, what will stocks do with this new information? It's certainly been a wild ride on payrolls and CPI these days, but as Goldman's Lee Coppersmith notes, a hit CPI like this suggests considerable downside for the S&P today. So again, even the big stock market gurus were predicting a big slide in the stock markets yesterday. I don't believe they saw that. I don't think that materialized for whatever reason. It says perhaps more notably, the market is now pricing in just one rate cut this year, pushing expectations from September to December. Okay, so that was yesterday's story on the CPI. Today, again, out of CNBC, we're talking about wholesale prices. The story from CNBC says wholesale prices rose 0.4% in January. Again, more than expected. It says a gauge of wholesale prices rose more than expected in January, though some details of the report indicated that pipeline inflation pressures are easing. The Producer Price Index, PPI, which measures what producers get for their goods and services, increased by a seasonally adjusted 0.4% on the month compared to the Dow Jones estimate for 0.3%. The BLS reported Thursday. Excluding food and energy, core PPI was up 0.3% in line with the forecast. It says stock market futures moved higher following the release, while Treasury yields were sharply lower despite the higher than expected headline number. So I believe that the 10-year it spiked yesterday big time. I think it pulled back a little bit today, more in that 4.54 range. And so, you typically see that also being stock market positive in connection with the weakening dollar. Wall Street strategists cited details of the report that suggested a slightly more benign inflation picture. In particular, it says some costs related to healthcare showed easing. Physician care, for instance, fell 0.5%. Also, domestic airfares, it says, declined 0.3%, and brokerage services prices were off 2.2%. Over the past year, the all items PPI increased 3.5%, well ahead of the central bank's objective. They want to be at that 2% range. That's their goal. Futures pricing indicates the market now does not expect the Fed to lower its benchmark interest rate again until October. While the producer and consumer price index releases are widely cited inflation gauges, they are not the principal ones used by the Fed. Rather, the central bank focuses on the personal consumption expenditures prices index, which the Commerce Department will release later in February. The PPI and CPI releases do feed into that measure, it said. It says Fed Chair Powell on Wednesday noted the Fed's greater focus on the PCE measure while telling the House Finances Committee that we're not there quite yet. That's a quote on inflation. Although he cited great progress being made so far. They're always going to say that, right? Otherwise, they come out and they look like losers, right? It says the reports are pushing back expectations for a rate cut until the second half of the year. Again, to me, that seems to be something the markets would, if they're pricing it in, would be pulling back as a result of. So it says producer prices for services increased 0.3% in January, while goods rose 0.6%. Services prices were led by a 5.7% jump in the traveler accommodation services category, which the BLS said accounted for more than 1/3 of the gain. On the goods side, a 10.4% surge in diesel fuel costs was a significant factor. The PPI data also reflected the massive surge in egg prices as farmers destroy millions of chickens to prevent spread of that flu. On the other economic news, Thursday, the Labor Department reported the initial filings for unemployment claims changed little for the week ending February 8th. Claims totaled $213,000, a decrease of $7,000 from the prior period and close to the 215,000 estimate. So there's your news on the inflation front. Again, a little bit of spin today to try to justify that, oh, it's all under control. But weren't we told back several years ago it was under control, it was all transitory? Well, these numbers are not bearing that out. Okay, going a little bit long today, but I wanted to catch up with my inability to get video up yesterday and address with you the CPI report. So there you have it, both of those pieces of news. I don't think it's great. I don't think it's necessarily stock market positive. Let's see how this plays out. We have more tariffs being imposed and tit for tats. Supposedly there's going to be a meeting between the Trump administration and the Putin administration on Friday relative to the Ukraine war. Gold continues to go up. It was up another, I believe, $15, $14 today, well over $2,930 per ounce. I will say this, not trading advice, not financial advice. If we do see a resolution of the Ukrainian-Russian war, I wouldn't be surprised to see a pullback in the metals prices. But obviously the metals are also, gold's reacting, I got to believe, also to this inflation picture, right? That the inflation is not coming down in many respects, it's going up, okay? So, and also you have fear, you've got economic fear, you have geopolitical fear and turmoil, a lot of unknowns of what the next move of the administration is going to be. That's putting, I think, a floor, so to speak, under the price of gold. Cryptocurrencies really been trading sideways, consolidating. Again, not an expert on that, trying to learn more about it. It's a big learning curve. But cryptocurrencies didn't today. They did not really follow the stock market. Stock market had a good day. Cryptocurrencies are still kind of going sideways. So almost 14 minutes today, going to get my workout here just in about 5 minutes. I'm recording a little later today. So you guys have a great rest of your day. Don't neglect that health. Don't neglect the diet. Don't neglect the workouts. Get those steps in. Thanks for watching. Talk to you soon. Bye.